Welcome to this seminar talk, and today I will be talking to you about Asian bonds. Now, first of all, everyone has heard about a lot of Asian bonds, and today I'll be sharing with you a few key features about Asian bonds and why you should be considering having Asian bonds in your portfolio. Now, before I start, today I will just do a very brief introduction about State Street Global Advisors, which is the firm that I'm working with. And I'll give you a strategic case of why Asian bonds should be part of the consideration of your investment portfolios. And I'll also talk about the Asian bond ETF, which is called PAVE in short. This is a first Asian bond ETF that is launched in Asia and is managed by SSGA. Now, SSGA is a global leading financial services provider. Now, we specialize in asset management. State Street Global Advisors is part of the State Street Corporation. State Street Corporation has got three major financial services areas. First is the asset management, whereby I'm working. Second is the custody services, I think some of you might have heard of. And thirdly is the global markets, whereby we do trading on exchange as well as equities. Now, State Street Global Advisors has been around for many years, and we have a very large presence globally. Our headquarters is in Boston, major centers in London, Tokyo, Sydney, and others. Now, within Asia itself, we have offices in Tokyo, Singapore, Hong Kong, and Sydney. And for fixed income, whereby I'm managing fixed income in Singapore, we have in Sydney, Tokyo as well. Now, SSGA has got a strength in many areas in terms of our global trading, as well as we also have a global alliance partnership with other companies as well. If you look at the assets of SSGA, it's actually very large. We manage close to 1.2 trillion of assets under management, of which a majority are made up of equities mandates. We also are very well known for passive investing. Nevertheless, we are also having a fairly substantial portion of active management under our assets as well. Now, SSGA is a very broad asset management firm. We offer a lot of different types of investment strategies, be it an active strategy whereby we actively seek to outperform any index that the client sets for us, as well as passively tracking an index, whereby we deliver index-like returns to match investors' return requirement. And we are also very active in other areas of asset management, including currency management, including asset class allocations, and various types of investment vehicles as well, including ETFs. That is one of the key focus for us today. Now, SSGA, on the fixed income side, we pride ourselves in the market specialization that we have. We have local teams spread out across many investment regions, and we have people who understand the local markets, stationed in the local markets itself. Thereby, we are able to gather market insights and do the research, and that would feed in through the investment portfolios for our clients. And we adopt very robust and disciplined stratified sampling approach. Now, stratified sampling basically means trying to use a technique of investment whereby we create a portfolio that mimic the index characteristics that the investors are looking at. So this is a very important technique that we use for our passive portfolio, including the ETFs. And of course, we have dedicated trading team that would enable us to execute at the best prices possible, given the market conditions and the liquidity in the market for our clients. And of course, it's a very important area, especially in this kind of environment, is risk management. And we have very stringent process in risk management, whereby we have independent parties, apart from the investment team, that will look into the investment portfolios that we have, and also critically assess whether we are matching the risk requirement of the portfolio. Now, SSGA has been around managing ETFs for a very long time. In fact, we pioneered the ETF concept globally. In that case, for the Asia side, we launched the first ETF in 1999. It's the Asia ex-Japan ETF, and that is actually a Hong Kong tracker index. And you can see that on the list itself, there are many types of ETFs that we manage. Today, I'll be focusing more on the one that we launched in 2005, whereby it's the first Asian bond ETF regionally, and in short, we call it PAVE. Now, let's talk about Asian bonds. Asian bonds has been around, in fact, many, many years. Now, Asian bonds itself is not something new, but it came to the attention of a lot of policymakers as well as investors from the 1998 financial crisis in Asia. Now, when you look at Asian markets itself, Asian markets, in fact, they have been growing very strongly. Now, the case for Asian bonds, you need to think of it this way. First of all, why would you want to be investing in Asia? Right? There are positive stories in Asia that you need to focus on. Now, the first one that I would argue is a very important point would be the positive growth trend and the strong growth trends in Asia. Now, if you look at the Asian markets itself, they have been growing very steadily on average 5 to 6%. And of course, for some countries like China, it's actually much beyond that. But you can see that on average, in most of the Asian countries, is somewhere around there. And that standard of growth is actually very high compared to the developed markets, as you will appreciate. And therefore, over this long period of stable and fairly high growth, the Asian economies has transformed itself. There are many kind of reforms being taken place in the economy, and therefore that has also improved the economic efficiency of the investment market as well. Now, the positive growth is very important because you want to be investing in a market, in a region whereby there is strong growth, there's potential for you to make money, as well as you are able to protect your capital. The next important aspect of Asian growth is the policy reforms. Now, the Asian economies have gone through a period of financial crisis in the late 90s, and they have taken drastic steps to improve the economic structure as well as the financial safety nets, at least through the many reforms that the central banks have undertaken that try to keep the banks safer. And of course, you have also seen the painful kind of retrenchments that has taken place in the late 90s, and that will start to have positive impact. In fact, we are already reaping the benefits of that. Now, the structural reform policies undertaken by the authorities themselves are very helpful in order to create a conducive environment for investors to invest. And that would also provide stability as well. Now, the other very important aspect that comes about through this the strong growth is also on the currency market side. Now, we have seen the Asian economies being very export-driven. They are slowly trying to change. That's part of the reform process as well towards more demand-oriented, consumption-driven. It's going to take time, but at the same time, we have seen the trade surpluses building up, capital inflows coming into Asia, and investors are gaining more confidence. So therefore, we have seen a steadily appreciation trend in the Asian currencies, and that is very important when you want to think about Asian bonds. Now, the other thing about the Asian markets, apart from talking about the economy, you need to think about the assets that you're going to invest in. And in this case, we are talking about fixed income markets. Now, fixed income markets is a bond market in general we call. Now, for those who may not quite understand, it's just like a borrowing, right? It's a borrowing that is actually traded in the public market. It means that the government or the companies could be borrowing from the capital markets, just like they would issue equity. Now, when you look at the fixed income market, you're talking about issuer borrowing from investors such as yourself, from institutional investors. It's very important you focus on the fiscal positions of the issuer or the borrowers. Now, in this case, we talk about an example using the sovereign bond market or the countries involved. Now, the Asian markets themselves, you can see in this right-hand side, we talk about fiscal deficits. I believe a lot of you have already been following the developments in the key markets. You can see that the fiscal deficits of the European countries or the developed markets are actually very negative. It means that those countries are borrowing more as a percentage of your GDP in terms of running the fiscal deficit. And if you look at the Asian markets themselves, they are at very small deficits, and some are in surpluses like Hong Kong and Singapore. Now, the reason that they are in surpluses is because they have very strong growth, and the reason for some of the Asian countries running a small deficit is because it's a natural kind of development whereby they are still growing, so there will still be some borrowing. But those kind of levels are very manageable as compared to those with close to 10% and more. So the fundamental situation in Asia is you are seeing a fiscal position much healthier than that of the developed markets. And we are also seeing that the bond markets in Asia are deepening. And by that I mean more instruments are being created for trading. The maturity of the bonds are getting longer. And why is that important? Because for investors, especially for pension funds and life insurance company, they need to buy longer duration assets. As you know, Asian populations are aging. And so therefore you need longer term durations to match that growing profile of demographics. And we are also seeing the Asian governments and the Ministry of Finance are also issuing more longer dated bonds that will create a more liquid benchmark curves for the corporates to price their issuance. And in Singapore, you have also seen a lot of bond issuance lately in Sing dollar. So, you can say that, the more active Singapore government bond curve that has been created would also allow more companies to come to the market to issue. And these shifting fundamentals in Asia itself would argue very positively for the development of the Asian bond markets. Now, the next thing when we talk about Asian bond markets and the investments, you need to look at it from a totality point of view, whereby you need to consider the diversification benefits for your total portfolio. And here I will take an example whereby I try to combine fixed income assets with other asset classes and see how do they stand up in terms of performance and risk. Now, if you look at this table itself, we focus on return, we focus on standard deviation, it's just a volatility, and we look at the Sharpe ratio, which is a kind of risk-free adjusted return comparison for the risk that you take. Now, of course, we have this thing called the beta, which is the sensitivity to a S&P. S&P is the US stock market. You can see that, for instance, Asian bonds, they have a return of 7.6. European governments almost 7. The US government bonds about 5.5. And of course, emerging market equities are very high, and so on. Now, in the next look at the return, the volatility is about 6 for Asian bonds and about 12 for European government bonds, 5 for US treasuries, and of course very high for equities in the emerging markets. Now then if you look at it, high return, high risk, right? This concept, everybody understands that. Now if you look at the Sharpe ratio, you can see that Asian bonds, meaning that you take the return and adjust for the risk that has been deployed, you can see that the Sharpe ratio is about 0.9, right? And if you compare that to the European government bonds of 0.4, 0.7, and even emerging market equities of 0.45, Asian government bonds is still much better in terms of risk-adjusted return. So what does that mean for you as an investor? It means for every unit of risk you take, the per unit return that's generated is much higher, right? So that is the beauty and the attractiveness of Asian bonds. And of course, you look at the sensitivity of the assets to the S&P 500, Asian bonds actually have very low beta or very low correlation to the US stock markets. So from that perspective, you know that having Asian bonds as part of your global diversified portfolio, that would make sense. Now, how about for investors who just invest in fixed income? I mean, maybe some of you do, maybe not all of you do that. But for investors who are just purely focusing on fixed income, now you'll be looking at, for instance, the currency diversification benefit. Asian local currency bonds themselves are very diversified, and we'll come to that. And they provide a range of markets that included countries very strong in economic performance and credit ratings, such as Hong Kong and Singapore, down to, for instance, countries like Indonesia and Philippines. Now, what is interesting to observe for your information is that correlations, right? Correlations, we talk about the movements of our market versus that market, how correlated they are. You can see that over time, right from before the year 2000, the German government bonds versus that of US has a correlation of 0.6. And that relationship rise over time to about 0.8. It's the same for other developed markets, UK 0.6 to about 0.76, Japan from 0.2 to 0.39, Australia 0.6 to 0.7. It means that in the global bond markets themselves, we are seeing a trend whereby if US markets were to go up, you are also seeing the European, the Australia, Japan, and UK also moving in the same direction. So now the previous conception of people has is that if you invest in the global markets, you are fully diversified. That argument is getting weaker. It's not saying that there's no diversification at all, but it's getting weaker simply because the correlation is rising. So you need to look out for assets whereby the correlation is lower. In fact, even better if you can find something which is negative to offset that, and you can achieve the diversification. And Asian bonds, you can see the correlation of Asian bonds with US is about 0.3, Germany is about 0.1, UK 0.3, Japan 0.2, and Australia 0.1, and it's actually very low. That means that it's very important for you to consider that. Now, when you look at the Asian bond markets itself, you need to think about the currency returns and the total return. Now, when people talk about Asian bonds, they think that the total return of Asian currency bonds may be mostly driven by currency. And we're going to debunk that myth. And I'm giving you a breakdown in terms of return. Asian bonds return, you look at here, is about 8.1, and that's measured over a period of close to 10 years. Yeah? And it's measured in US dollar, and it is unhedged. Now, if you look at the return breakdown, close to one-third is coming from currency, and about remaining two-thirds come from bond returns. It means that when you invest in Asian bonds, you do not just get exposed to the currency return. In fact, you are getting more. You're getting more from this bond return, and what is this bond return about? It is about the structural changes that is taking place in the Asian economy. You are seeing a progressively well-managed economy through the monetary policy management. Inflation in Asia getting more stable, so the natural interest rate is getting lower over time, and that would mean that for investors, you get that positive return, right? So when you invest in bonds, there are few sources of return which I will come to. Now, when you look at the attractiveness of Asian bonds itself, you need to also compare, for instance, the kind of volatility and return. Now, the other thing that people talk about in Asian bonds is, oh, it must be risky. It must be high risk. And so maybe that's why the return is higher. Then if you compare that again, Asian bonds return 8%, risk of about close to 6, US 5 and close to 4. You just do that kind of math, and you can see that, in fact, Asian bonds are not at all that risky as some would say. Now, in fact, if you look at the volatility, the kind of progression of charts of Asian bond return, focus on the green line, right? Green line is I'm using an index return as an illustration of the Asian bond market. The green line over a period, right? We're looking at 12 months rolling. Of course, during the financial crisis, it did come down. Okay, no assets markets can actually avoid that. But you're seeing that the Asian markets rebounded fairly strongly, and on average has been staying above. Now, this is the kind of markets that you want to be considering and to think about when you're investing. Now, when we talk about the Asian bond markets, gaining access to the Asian bond markets could present some of its challenges as well, because for some of the markets, for individual investors, you may need to invest in each of the markets on your own. Now, there is this Asian bond ETF called PAVE that has been created. This Asian bond ETF is a bond ETF that was listed in 2005. It came about through the conscious efforts of the Asian central banks right after the Asian financial crisis. Now, they formed something called the EMIAP. The EMIAP was around, in fact, much longer. And they decided to come up with an Asian bond project called the ABF2, now ABF Bond Fund Initiative 2. And it created and they seeded the Asian bond fund there were actually two projects. The first one is the 1 billion fund to create an 8-market fund, which is the one that we are managing. And the remaining 1 billion, they slice to 8 parts and have each country manage their local markets. Now, for the Asian bond fund that we manage, it is actually comprised of 8 markets. Now, you can see that it comprises China, Hong Kong, Indonesia, Korea, Malaysia, Philippines, Singapore, and Thailand. And these are actually very diverse. Think about it, if you are individual investors trying to gain access into all these 8 markets on your own, it is actually quite challenging. So what is interesting about this proposition of this bond fund, it gives investors the instantaneous access to 8 markets all at one time. So this is something that is very unique. Now, if you even want to focus on China, now the Chinese yuan for this bond fund is trading the onshore interbank bonds. As you would know, the Chinese market is actually very close, and not all investors can have access to the onshore market. So this uniqueness about this Asian bond fund itself is that it is investing directly into the onshore Chinese yuan bond market. In fact, it is first of its kind in that time that has been granted this direct access since 2005. Now, when we talk about Asian bonds, and just now I talk about the total return of any bonds, you need to consider the total return of the income from the bond market, as well as currency return if it's a kind of a regionally managed portfolio. Now, for the Asian bonds funds, there are 3 key strong advantages that I think investors should be considering. Now, first of all is you get a constant regular income through the bond itself. Now, this bond fund invests in markets right from China, as you have seen previously, all the way down to Indonesia and Philippines, and it accords a lot of diversification, and as well as different yields in the different markets. Each market has got different interest rates, and combined, they give you that kind of return income. And this bond fund itself pays dividend twice a year, so that's also a fairly good information for you to know. Now, of course, it also gives you the prospect of currency appreciation. We talk about the current account surpluses, the capital inflows, and the growing huge foreign reserves of the central banks. So that gives investors the confidence and the kind of strong proposition for them to be invested in Asian bonds. And of course, it's very important aspect is that it offers diversification. When we invest in any assets, we just need to consider the return, the risk, as well as the diversification for your total portfolio. Now, when you look at the Asian bond fund itself, you may wonder where are the sources of return. You can see that over the period that we have analyzed for close to 10 years, the returns come in varied. Some markets like Indonesia and Philippines are very high. That's because they came from behind, right? They were less developed, and over the period of 9 to 10 years, they have actually made a lot of progress. And you can see that the kind of returns coming from these markets itself is actually pushing the total return contribution very high. Now, some of the markets you may see that, for instance, the breakdown of return. For instance, the Chinese bond markets. Now, we are looking at about 3.5% of return from the bond market itself, and about 3.8% coming from the currency. Now, in this case, investors do benefit from currency return, but of course for Hong Kong, the currency doesn't really move, so you don't get much. And in the case of, for instance, Indonesia, bulk of the return came from the bond market, because structurally Indonesia has very high interest rate 10 years ago, and now the interest rate has been coming off, so you have the huge capital gain as the bond yield were to decline. Similarly, you can consider that different markets have a different breakdown of returns of bond versus currency, and that gives you a very good form of diversification as an investor. Now, the thing about Asian Bond Index Fund is the concept and the design of the index. Now, if you look at the indices widely available in the market, people are creating indices based on market capitalization. By market capitalization, it means that in the case of bond market, the larger the bond market, the more allocation it is to that index. Which means that if a country or a company borrows more money, you will want to have it more in your portfolio. Now think about it again, right? Now, if things are doing well, then it's fine. If the conditions of the market are getting more challenging, if somebody is borrowing more, it may be that he is in financial difficulty. So borrowing more doesn't mean that you should include more in your portfolio. So that's first thing. So market capitalization has got some of its weaknesses as well. So when we designed this Pan-Asia Bond Index Fund, we worked with the regulators and they came out with a new concept of indexing, which is at that point in time, not many people could appreciate. That's actually more than 7 years ago. Now people will appreciate that. So when we look about the Asian bond market construction, first of all, market capitalization, of course, has to be considered. So we still have that is the size of the market. The next thing we need to think about is the liquidity of the market. So when investors invest in the Asian market, they want to have more allocation to a market whereby it's more liquid because you want to get in and have the ability to get out as well. So you need to consider that. Then the third factor is the sovereign debt rating. A sovereign country which has a higher rating is better, right, in terms of fundamentals. So you want the country to be included and be given more weight. And the fourth factor, lastly, is called market functionality. Because the Asian bond markets are developing over time, you need to consider the progress of the development of the bond markets, the deepening of the debt capital markets, whether they are creating more instruments, whether they are making it easier for investors to get in without withholding tax or any capital controls and so on, whether the infrastructure is making it more conducive for active trading. So we look at this as more of a qualitative assessment, and they consider these four factors in designing the new index weight, and that is the beauty of that. Now with that, you can actually come to appreciate that have we been using market capitalization, meaning the size of the bond market, China and Korea will dominate. This is the gray bar, simply because the economies of these two countries are very big, but then it doesn't give you the diversification. So with the new design concept of the index, we have these green bars whereby you can see that the dispersions are getting less, meaning that you have a more diversified weighting to the Asian bonds. So these Asian bond markets, as you can see, comprises of 8 markets, with China close to 21%, and the second largest being Hong Kong, and so on. So they are fairly well diversified and spread out, and in terms of average rating is somewhere around single A to AA, and the duration is somewhere around 6, and the average yield is close to about 3. Now, the performance of the bond fund, we can come to talk about it later on and so on. We can discuss after that. Is very much closely tracking the index. As you can see, since inception, is somewhere around the 7+% to 8%. Now, for investors getting into the Asian bonds, you need to consider about how you want to gain access. For investors who just want to have allocation to Asian bonds, I would suggest the easiest way just to use the ETF for asset allocation, because it is passively managed to track the index, so you don't need to worry about the ability to outperform and so on, and the underperformance. And it's very liquid, and it has got high diversification and very low cost in terms of trading and very transparent. Now, the Asian bond markets, the pay structure itself is very low cost and very transparent, and it's actually well regulated itself. I would just come to this page as my last page to talk about it. This fund is listed in Hong Kong. It is also recently cross-listed in Tokyo, and they are actually well regulated by both the authorities in Hong Kong, Singapore, as well as Tokyo. The fund size currently is close to about 3 billion. Now you can trade it as long as you open a trading account with your equity brokers and so forth. And the price is in US dollar. Bear in mind the trading is actually in US dollar. And so therefore, it's around 127 per unit, and it has a very low expense ratio. And that's very important. A lot of different funds, they have different expense ratio, and in this case, it's very low expense ratio. It's very good for investors to do asset allocation. Now, I guess I've come to the end of this, and the main summary is that I need to drive home for you is when you look at Asian bonds, you need to consider a few facts and a few issues. First of all, consider the growth environment of the markets that you're investing. Secondly, consider about the risks as well. Yeah, it's very important in terms of how volatile it is, the return prospects, and what are the breakdowns of risk and return. And lastly, how do you gain access in terms of the best execution approach for your portfolio? And with that, I will end my presentation. Thank you very much.